Hey everyone, welcome back to Corporate Decoder. Today, Hawaiian Electric Industries Incorporated just filed its quarterly report, and I'm seeing some big shifts that tell a story about their fight through wildfire aftermath and their future energy plans. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is navigating massive wildfire liabilities while pushing hard into renewable energy, and this report shows how they are balancing those huge challenges. Let's dive into what Hawaiian Electric Industries and its main subsidiary Hawaiian Electric Company are reporting for the second quarter, ending the 30th of June 2026. They are dealing with the huge costs from those devastating Maui wildfires, but they also just got some good news on their credit ratings. Looking at the income statement for Hawaiian Electric Industries, we see a massive jump in revenue to $939.7 million for the 3 months ending the 30th of June 2026, up from $746.4 million in the same period last year. This is a huge 26% increase. The biggest driver here is their electric utility business, which is bringing in way more money. But here's where it gets really interesting. Their operating income jumped a massive 280%, from $53.7 million to $204.2 million. Now, a big part of this surge, as they explain in the notes, is a massive adjustment related to reevaluating their wildfire settlement liability. Essentially, they were able to reduce the amount they owe for those wildfire claims, which made their operating income look much better. And that flows straight down to net income. For common stockholders, net income soared from $26.1 million to $123.2 million for the quarter. That is a staggering 372% increase. Again, a huge part of this is that settlement liability adjustment, but they also saw higher interest expenses due to the ongoing accretion from that settlement, which is a bit of a mixed bag. But overall, the net income numbers look dramatically improved. Now let's look at the Maui wildfire situation, which has been a massive burden. For the 3 months ending the 30th of June 2026, the net impact of wildfire-related items was actually a gain of $139.4 million for Hawaiian Electric Industries Consolidated. This is mainly because of that settlement remeasurement, where they reduced their estimated liability. They also recorded insurance recoveries. This is a huge shift from the same period last year when these wildfire items were a net expense. In their balance sheet, you can see the impact of this settlement. The wildfire tort-related claims liability has dropped significantly. For Hawaiian Electric Industries Consolidated, it went from $1.4 billion at the end of 2025 down to $890 million as of the 30th of June 2026. This reflects the payments made and the remeasurement. They also settled a securities class action for $47.8 million, which was largely covered by insurance. This is a good sign that they are cleaning up past issues. The company is also in ongoing litigation with some of their property insurers regarding claims from the Maui wildfires, seeking significant damages. This is a situation to watch, as the outcome could still impact them financially. When we look at cash flow for the 6 months ending the 30th of June 2026, net cash provided by operating activities was $91.5 million. This is down from $216.2 million in the same period last year. A big reason for this drop is higher cash paid for fuel oil and higher customer bills due to rising fuel prices, which means they need more cash on hand to keep operations running smoothly. Investing activities show a significant increase in cash used, up to $240 million from $154.8 million last year. This is largely due to increased capital expenditures for construction, which is a sign they are investing in future growth and infrastructure upgrades. Now, let's talk about their credit lines. As of the 30th of June 2026, Hawaiian Electric has $300 million in unsecured revolving credit, and it is completely undrawn. This shows they have access to significant borrowing capacity if needed. Overall, Hawaiian Electric Industries Consolidated has about $1.3 billion in total available liquidity when you combine their cash credit lines and an at-the-market offering program. This suggests they have enough cash to manage their immediate obligations. And here is some good news on the credit front. In April and July of 2026, Moody's and CMP both upgraded Hawaiian Electric's credit ratings. This is a huge positive, especially after those wildfire-related downgrades. It means they are seen as less risky, which should help them get better terms on future borrowing. For example, CMP moved them to a stable outlook from a credit watch. But here is a challenge they're facing. The average fuel oil cost per barrel has jumped significantly. For the 3 months ending the 30th of June 2026, it was $145.67, up from $100.40 a year earlier. That is a 45% increase, while they can pass most of this cost to customers through their rate structure. It does create a timing mismatch for cash flow. Despite higher prices, their kilowatt-hour sales actually dipped slightly by 0.8% in the second quarter compared to last year, mainly due to cooler weather. Looking ahead, their wildfire mitigation efforts are a major focus. They have a comprehensive plan approved by the regulators, and they're getting funding through an exceptional project recovery mechanism. This shows they are proactively addressing wildfire risks. They're also heavily invested in modernizing their grid and transitioning to renewable energy. Their integrated grid plan is a big deal, aiming for 100% renewable resources. They've met all their renewable portfolio standard goals so far, and they're aiming for net zero emissions by 2045. While the company is making strides in renewables and managing its wildfire liabilities, some analysts are cautious. Headlines like Hawaiian Electric, the glory days are over, maintain strong sell from seeking alpha highlight concerns about core earnings despite profit surges. The market seems divided, with some seeing a strong trading volume and others warning about thin core earnings. Morningstar points out that a rate rebase is critical for them to actually earn the returns the regulators have allowed. This means their future profitability is really tied to regulatory decisions on their prices. So, bottom line, Hawaiian Electric Industries is in a complex spot. They've successfully navigated some major wildfire liabilities, boosted their credit ratings, and are pushing forward with renewable energy plans. However, they still face significant challenges with rising fuel costs, the need for regulatory approvals on rates, and the ongoing work to modernize their grid. My biggest concern is the delicate balance they must maintain between investing in renewables and managing those massive wildfire liabilities, all while keeping electricity affordable for customers in Hawaii. What I am actually looking for is continued execution on their grid modernization and renewable energy targets without jeopardizing their financial stability. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check the Discord in the description.